everyone, and welcome to episode 5 of the Unpacking Alpha podcast. I'm Sebastian Lander, portfolio manager at Pack Capital.
I'm Camilla Goldingay, the business development manager at Pack Capital.
And we're very lucky today to be joined by Steve from Aoris Investment Management. Welcome, Steve.
Thank you, Seb. Thank you, Camilla.
It's great to have you here. So maybe we'll just start with, who are Aoris Investment Management and what role do you play there, Steve?
Well, great introductory question. So, Aoris Investment Management, we're now 5 years old, and we are a specialist international equity manager based in Sydney. We're different in a few ways, but we're staff owned, we're a boutique, and we've been set up to just do one thing, do it well. So we're a specialist international equity manager.
Brilliant, brilliant. What's your role then at Aoris?
Well, my primary role every day is an analyst, and so while I'm managing director of the firm and chief investment officer, when I come in every day, what I spend most of the day thinking about and reading about is stocks as part of our investment team, and that's what always gets me most excited.
And look, I think there are a lot of global equity managers available to Australian investors. What do you think sets you guys apart from other global equity managers?
Well, you're right. There's a myriad of options when it comes to international investing. How are we a little bit different? Well, the first is we own a relatively few number of stocks. And we can talk a little bit about why that is, but we own just 15 businesses. And we think that allows us to set the quality criteria at unusually demanding levels, as well as the valuations when we're thinking about allocating capital to a position. It allows us to be very considered and patient when it comes to replacing a stock. So we want to make the best decisions we can, and we think that if we make fewer of them, that will lead to better decisions. So 15 stocks is quite different, and that works well for us. There's lots of parts of the market that we won't invest in, which we can talk about as well. So the composition of the portfolio looks very different from many other managers. So that's a few ways. And perhaps the third one is we know that there's not an infinite amount of client capital that we can run the way that we run it and do it well. And so we've said from the outset of the business that there's a finite amount of assets that we'll invest for clients. And as of today, we'd set that limit at $5 billion.
Brilliant.
Great. I think that leads into my next question is what sort of stocks do you typically own?
Great. Well, this is where the rubber meets the road. And what do we own? And if someone looks into the portfolio, what are they going to find? Well, they're going to find some of the world's most outstanding businesses. We want, as investors, we want to own businesses that become progressively more valuable over time. And it's hard if a business doesn't grow, it's hard to become more valuable. So growth is important. It's got to be profitable growth. It's got to be durable growth, not sort of run out of steam in 3 years. And for us, a business growing in line with its market is not quite enough. We want businesses that grow faster than their market, that represent them continually gaining market share.
Right.
And that starts to speak to something special, and we want to own special businesses, so market share gainers. Now in our portfolio, you'll see businesses like L'Oreal, LVMH, Louis Vuitton, Nike, Accenture, some of the more familiar names in our portfolio, and they really embody that characteristics of consistent, good growth in excess of their markets. They're businesses that have been doing that for a very long period of time, which gives us confidence that as we look forward, that durability of attractive growth rates and attractive profitability can continue. It's got legs, if you like.
Yep.
Importantly, in an environment we're in with interest rates getting higher, a conservative capital structure matters a lot as well.
Yep.
And lastly, we want businesses that remain very profitable in difficult years. We never know when difficult years are around the corner. We like to be confident that even a tough year is still a very profitable year. And right now, perhaps that's more important than ever.
Yeah, absolutely. So I guess just to sort of jump in on something you said there. So you're obviously trying to find these really high quality companies, right? And as you said, I think in your first response, you do set a very high bar for quality. So how do you find those really high quality companies being a manager based in Sydney?
Well, there are quantitative screens that can help if you go into a database and tell it to find me businesses with a certain level of profitability. That's a good start, and businesses with debt levels that aren't too onerous. But of course, it's a pretty crude tool, and it's only ever backward looking. So it helps us to screen out the types of businesses that we're not interested in.
Yep.
Yeah, that's a good starting point. To take out all the less profitable businesses in industries that we're not interested in, banks, energy, utilities, and others, and it starts to narrow it down. But then it starts to get into reading annual reports, and I think perhaps what's really key for us is having a very clear idea of the sort of businesses that suit our style. And that makes it very easy to identify in a brief read of an annual report. Does this really feel like? Does it embody the quality, the depth, the durability, the specialness, the sort of business we're looking for, and allows us to discard marginal businesses pretty quickly and focus our energies on the truly special ones.
Yeah, right. Yeah, so I guess then the next question, and leading on from what Cam was
Yeah.
sort of asking, is what sort of businesses would you not own typically? Then I think you did mention banks.
Yeah, well, there are many of them, and if we think about what industries are just generally not, there might be businesses with cyclical or episodic growth, but they're not going to. There's no structural growth to them. Heavy industry, um, construction, utilities, telecommunication, um, and banking
Mm.
are all businesses that grow less than the economy. And when it comes to banking, they're inherently very leveraged businesses. They're very opaque as well. It's hard for us as an outsider, as has been found out with the regulator this in the US. Do they
Mm,
really know the quality of a balance sheet of a bank? We sure don't.
mm.
And so for us, we just rather take it out of our opportunity set.
All right. That's a great answer. So I guess on the flip side, what types of stocks does your process tend to avoid?
Yeah, well, industries that just don't have any growth for them. So heavy industry, mining, energy, uh, telecommunication, utilities are structurally going to grow less than the economy.
Right, right.
Businesses where there's just no differentiation, commodities, they're called commodities for a reason.
Yeah.
Banks are by their nature very leveraged, very opaque businesses, and businesses where the government plays a big role in how an industry operates. And because we like businesses that are in charge of their own destiny, and a regulated industry is always susceptible to the government sort of picking up and moving the goalposts.
Mm.
Now, that's very true in much of healthcare. The government's the largest purchaser of healthcare services in every country in the world,
Yeah, right.
and they will set reimbursement rates and patent lives and so on. So a lot of that healthcare ecosystem is for us. It's subject to government influence in a way that doesn't suit us.
Yeah.
Now, as we saw last year, semiconductors, the whole semiconductor ecosystem has now become one where the government is playing a much more overt role in a way that it moves the goalposts around. It changes the range of outcomes. It might be that in 5 years' time, the government hasn't really had a material negative influence, but the potential is there now in a way that wasn't apparent a couple of years ago. So those businesses, for us, they're ones we just happily take a pass on, and in preference to businesses that are steering their own ship, if you like, and growing without at risk of the government getting involved in a way that's negative for the business.
Brilliant, brilliant. And I guess again to pick up on something you said, you're sort of building a highly concentrated 15 stock portfolio. Does that mean you keep your best ideas to yourself, or do investors know what you own?
We choose to be 100% transparent, so people can go on a website and they'll see every holding.
Oh, brilliant.
And more than just the name, in fact, you can see a description of the business. You can perhaps in some cases see links to corporate videos. So we see our role as we are in business owners. And we liked for people that invest through us to feel that as well, that they don't just own units in a unit trust, that through our portfolio, our investment vehicles, they too are owners in Costco. They too are owners in Nike. They too are owners in LVMH, because that's how we think about it. And transparency helps to lift the lid, if you like,
Yeah.
and allow people to feel that it's more than just a unit price. There's a set of businesses that they own, and we like people to understand what they do, what we see that's special about them, and we show that every month.
Brilliant, brilliant. And maybe I should have asked this at the start, but I guess you're obviously the founder of Aoris, and you have a quite a unique style. Where did you develop that style? Have you always practiced this concentrated, sort of very high conviction approach, or do you model yourself on like a Buffett? I hear you sort of talking about being a business owner, right? And that's something he sort of says.
I guess it's well, I started investing in 1991 and moved into international markets in 1994 at Platinum Asset Management. And through that long journey, I've taken nuggets of what kind of connects and resonates with me, observed uh, mistakes and my own and those of others, and over time sort of shaped an approach that I've been operating with since 2011, so 12 years. So it's sort of very, very consistent, and some of those key tenets of the approach, the concentration, the patience, the exacting standards don't suit everyone, and you won't find them in many portfolios. But having been doing it for well over a decade, it really suits me. But we're always trying very hard to get a little bit better every year. There's always lessons to learn, and that's, I think, what makes the journey very stimulating. Interesting books to read, and there's ways that you develop your own mental models that you can apply into your investment decisions. Observe how others are, how the market operates, how other investors make decisions, things that they get wrong, and as we've seen plenty of the last couple of years, and try and constantly to feedback those lessons into how we think and operate, and always trying to get a little bit better.
Yeah, brilliant, brilliant. So I think you did touch on this, but I guess from what you said, the macro backdrop, it doesn't play a part in what you do.
We want to sit in what we call a macro agnostic zone, such that we can open up the papers tomorrow and whatever's on the front page won't trouble us. We wouldn't change our portfolio at all, even if we knew tomorrow that things are going to be good or bad. Now, in order to do that, we have to make our portfolio look very different from average. There's lots of businesses that we need to avoid in order for us to be macro agnostic.
Right.
So not owning energy companies allows us to not worry about energy prices,
Yeah, of
not
course.
worry about geopolitics. Not owning banks allows us not to worry about interest rates and monetary policy and stress and regulation in the banking system. Not owning semiconductors allows us not to worry about the geopolitics that's inherent in that industry.
Mm.
Um, and not owning inherently very cyclical businesses allows us not to worry too much whether the economy grows a bit faster or a bit slower this year, and instead own these durable all-weather businesses, with strong capital structures, competitively winning, leading businesses. So we're very different from the market, but allows us to operate in that really macro agnostic zone, and it frees us from a lot of the concerns that I think a lot of investors are struggling with at them right now, and probably struggled with the last couple of years when they try to read the tea leaves and look around corners and think about what's coming next for the economy.
Yeah, right.
So I guess on that, where are you seeing opportunities in global equity markets now?
Well, for us, I think the opportunity is all about quality, and the opportunity is, I think, particularly attractive right now when we look at valuations. Valuations always matters to us, but the valuations for our portfolio look particularly attractive right now. Now, when we say quality, how I guess substantiate or validate that is one of the key lessons for us as we think about the last 3 years since the pandemic began is how much better the best businesses in the industries that we're interested in have performed relative to their peer group.
Mm.
Now, an analogy that I like to give is if you're thinking about a group of cyclists, perhaps you go on your way to work and you see a group of cyclists and they're going downhill and everyone's going pretty fast because the hill's doing all the work. And the strongest rider might be a little bit faster than average, but not much faster. And then they get to the bottom of the hill and they turn around, they go back up. And then the pack really spreads out, and the stronger riders right at the front, and there's a big gap between them and the average and the weaker riders. Well, I think there's a lot of interesting lessons in that, and we've really seen that over the last few years, where the better businesses have really pulled away competitively from not only their peer group and the average business, but even the second best business in their industry. And that draws on some of the strengths that made them the leading business in the first place, size and scale and brand, but also decisions that management made in the toughest periods of the pandemic. How do we look after our employees? How do we think about servicing our customers? How do we think about managing inflation? How do we think about managing all the challenges? And the better businesses have simply made sounder better long-term decisions that have really seen them pull away from their pack. And to give you perhaps a couple of examples, in the 5 years to 2019, L'Oreal grew about 2% per annum faster than the global beauty industry. Okay, that's great. It satisfies what we're looking for in a business that grows faster than its peer group. But in the last 3 years, it's grown about 6% faster. It's significantly outperformed not only the industry, but even its closest peers, such as Estee Lauder. And in the parts of the market that have been most challenging, that performance gap has been largest,
Really?
and China being a good example. We've seen the same with Nike versus many of their sporting apparel peers, and the gap versus themselves and Adidas quite stark. And we've also seen it with LVMH versus some of their peers, Accenture versus their peers. So for us, it's always about quality, but it's been particularly powerful when conditions have been more challenging, which gives us a lot of confidence as we look forward. And if 2023 and 2024 turn out to be challenging years, we're confident that the types of businesses, the specific businesses that we own, will perform much better than their peers, because we can see how it happened over the last 3 years. And to Camilla's point, that the attractiveness of this outstanding set of businesses today is enhanced by the prices that we own them at, which look particularly attractive today versus what we think that they're worth.
Yeah.
Brilliant.
Yeah.
Brilliant. Maybe we could sort of take the other angle on something you just said there, I guess, about the quality. And you don't necessarily have to name the stock here, but have you had, or could you give us an example where you've seen a lot of quality, but then you've seen a couple of red flags in your process that's made you sort of step away from a stock on quality grounds?
Well, there's it's like there's lots of businesses that might satisfy other people's definition of quality that aren't in our portfolio. Sometimes it's because of price. Sometimes the quality is not quite there. Sometimes they're a tier two, a second or third player in an industry, and we're only ever interested in the best. It's the best or nothing for us.
Yeah, right.
Or it's a business that may be a little bit narrow, and that in turn creates some fragility in the business. And we like sort of broad, robust businesses that what we call a multi-legged stool, rather than a one-legged stool. And that fragility sometimes becomes more apparent when conditions are difficult. And you can see as perhaps that the cycle starts to go uphill. A business is dependent perhaps on a narrow customer base, a narrow market. Right now, if you think about businesses in the US or Australia that serve the housing market, the last few years might have felt good times, but it's only becoming apparent how much buoyant consumer spending, low interest rates contributed to that. And now things are becoming a bit softer and more challenging for businesses in that narrow market.
Okay, brilliant. Well, I guess this is, again, we're sort of talking about process here a little bit, but you're looking at those 15 companies that you sort of have. Do you have a sort of a watch list or like a second list of guys that are sort of waiting, or guys and girls that are waiting on the bench?
We do. It's a two-tier bench, and
Okay.
perhaps a bit like a sporting team. You've
Yeah.
got your first reserve team and your second reserve team, and so we have that. Those two teams are about 20 businesses each, some to about 40, and periodically there are those where you think, you know what, they're not quite up to our standards, and they come up, and so we're always actively looking for businesses that are better than what's on our bench. But what it allows us to do, it's a very considered, patient, deliberately slow, long gestation approach, so that the businesses, if you like, sort of percolate up through the second reserve and the first reserve, eventually into the portfolio. But by being deliberately slow, it means that we'll know the business a lot better than if we sort of rush the process. Perhaps it's a bit like if you meet someone for the first time, this weekend, then you might walk away from that lunch with a pretty a first impressions view of their character. But if you meet them a few times, eventually you'll be able to make a better assessment of what's this person like. And perhaps if you're interviewing them for a job, likewise for us, we want to allow time to be our friend, and not feel like we read an interesting annual report and we need to rush the process and bring it into the portfolio. Where it's rushed and accelerated, we're just more likely to find out in time that that we made an error in our judgment.
Yeah. I guess then, you sort of said you got 15 stocks and you're different to peers. Would you also then be very different from like major benchmarks and indices that people sort of, I guess, associate with global equities?
It's different as you can imagine.
Yeah.
So, um, there's yeah, because we own 15, and the benchmark's got thousands.
Yeah.
And if you were to compare us to many other portfolios, even those where that they speak to quality, it's everyone's definition of quality is a little bit different, but ours is deliberately exacting, and that's I think that's really stood us in good stead the last couple of years, where owning only the best businesses helped us to have businesses in the portfolio that have navigated challenging conditions just better than second best and third best businesses. It kept us out of narrow businesses that turn out to be a bit fragile, kept us out of businesses that might have had a terrific period in 2020 and 2021 that might have created the impression that the business was better than it really is.
Yeah, right.
And then as that tide ebbs out in 2022, they turn out to be good but not great businesses, and we're only interested in great. So it's deliberately different. It's very exacting, and by owning just 15, it allows us to have quality standards that I think you'll rarely find in other portfolios.
Brilliant.
And maybe tell us a little bit about recent earnings results of your holdings.
Yeah. Well, while there's no doubt some concerns about slowing corporate earnings in aggregate, and there's lots of patches of the economy that understandably are going to slow, across our portfolio, we've been very reassured by the continued good revenue and profit growth, and the continued outgrowth that we're observing compared to their peer group. Perhaps give you a couple of examples.
Okay.
When Accenture reported around the middle of March, while on the one hand, some of their large corporate customers are perhaps slowing down on large projects and engagements. We're seeing very little of that, and Accenture continues to grow at a good rate, around a sort of 5 or 6% rate before the contribution of acquisitions. They continue to do it at very attractive profit margins, and they continue to gain share in their market. And a key word there, which I think is important for across the portfolio, is that they remain very relevant to their customers.
Okay.
So right now, for Accenture's customers, front of mind might be cybersecurity, front of mind might be artificial intelligence, front of mind might be machine learning, front of mind might be banking regulation. And Accenture's breadth of services, going back to that multi-legged stool, allows them to have a lot of ways that they remain relevant to customers. And they signed 35 deals in the quarter with a contract value of more than $100 million. And it's the second highest number of such deals in their history. So that speaks to there's a very good pipeline of large contracts that will feed into revenue in the coming years. So Accenture is one good example. Another good example, reporting in late March, is a business in the United States called Cintas, and they're America's largest uniform rental company, and they provide a variety of other services as well. But if you can imagine a business like a hotel in the hospitality industry where people wear uniforms, they can buy them, or the employees can buy them, or they can rent them. And Cintas is the largest in providing that rental service. So they'll take away the dirty uniforms every week, launder them, and replace them with fresh ones. And that business grew on an underlying basis by more than 10% at profit margins that were comfortably higher than a year ago. And they continue to find lots of businesses that don't currently outsource their uniforms. And Cintas has got a compelling offering. It works out to be about $1.50 per uniform per day. Which is a lot less than I pay for my coffee in the morning. It feels pretty compelling. And there are other things that they can do as well, including checking the first aid cabinet, and particularly in a tight labour market where organisations might find it's hard to find people to allocate these tasks to. Cintas can kind of take that off their mind. So uniform rental plus other facility services, it's a compelling offering, and it's got a long history of growing at that kind of high single digit rate, and they're growing even faster than that at the moment at profit margins higher than a year ago.
Brilliant.
Really interesting.
Brilliant.
And are you seeing any emerging trends from your current portfolio companies?
I think there's probably trends going on outside them, if you like. So in the context of the economy, consumer spending is shifting a little bit from goods to services. I can imagine in Australia, Bunnings has sold lots of stuff in the last couple of years that people don't need to buy again in 2023 because people are spending the money on other things like holidays, perhaps. So there's a reallocation in an economy that remains, I think, broadly healthy. Unemployment rate's very low, but the composition of the economy is shifting a little bit. So for businesses perhaps that are a bit narrower and then that play to those slices of the economy that are growing a bit faster or a bit lower, that might swing those businesses around. But for us, by owning broad businesses, we don't really see that showing up in our portfolio companies.
Okay, brilliant. Okay, so I guess you touched on valuations earlier, and this is a kind of a bit of an outlook question, but I take, are you feeling pretty confident about your portfolio from here for the next 3, 5, 7 years?
Yeah, look, we think and encourage people to think about a longer term horizon. 5 to 7 years, I think, is a good time frame. We're confident that we can deliver returns in the 8 to 12% per annum after fees band, which is our target. Confident that we can do it from here over to 5 to 7 years. How 2023 pans out is just 1 year in that sort of longer term horizon. But I think a good place to be is high quality businesses. Valuation matters, and right now we feel our portfolio of these exceptional businesses is unusually attractively valued, which gives us confidence that we can deliver on those long-term outlook.
Brilliant, brilliant. And I guess just one final question. So you're personally invested in the portfolio?
It's an important question. All of my family's personal investable capital is in the portfolio. Don't own any fixed income, any Australian equity stocks. It's all in the portfolio. And as a principle, for every person who works in Aoris, the only way that they can invest in international equities is through the portfolio,
Right.
which means that they can't own stocks from the portfolio, a subset of stocks, if you like. They can't own anything outside the portfolio. The international investing must be done through the portfolio, which means that we're all clients, that we get whatever the experience clients get, we get. And we're not trying to outdo our clients by owning our favourite subset of stocks. We're all clients through the portfolio, and that's the only way, and keeps things very simple and very aligned.
Yeah, very aligned. That's great. Well, I guess just one final question from me then. So are Arsenal going to win the Premier League this year? I know you're a massive football fan.
Well, from where we sit today, which is at the end of March, there's 10 games to go. And I think the odds slightly favour Arsenal. Although I think it's pretty much at this stage a two-horse race. Manchester City has got a long, recent history of performing at exceptionally high standards, and so I certainly wouldn't write them off. It's going to be an exciting close to the season. My money's on Arsenal.
And whether or not we publish this podcast or not, or West Ham going to go down.
It's going to the relegation's perhaps even more exciting than the top end of the table. But I think look, West Ham have got some great players, some of whom Arsenal would like to recruit, and I think that'll keep them in the top flight next season, and they'll stay up.
Okay, congrats. Thank you very much.
Thank you so much.
Great, Sebastian. Thanks, and Camilla.
Thank you.